Okay, I want to talk about something this afternoon a little bit. I want to talk about deleveraging, and I'm going to also talk about mark to market. Uh, Back during the last financial crisis, this was part of what actually was the cause of the crisis was mark to market. And I'm going to use my own way of trying to describe these things so you understand what mark to market is. Basically, picture it this way. If somebody was forced into a forced liquidation, like say a person had an estate, for instance, and they were forced by the bank to liquidate the estate, they would have to sell those items, and say they had a big auction with no low bid, and people came in and auctioned. It would all be available to the amount of buyers that would be available. Say 100 people came to their auction. Okay? Some of the items might go for extremely low prices because they're liquidating it, and the people that are there at the auction, if there's no bidders, it might not get much. It's only valued at what somebody can use it for, or if you have a buyer that really wants it, then you get a good price for something. But if you got no real buyers and there's no what's called a bid, then at the auction they wouldn't get very much for their stuff. Some of the stuff might be antiques and stuff, and people might be buying it for next to nothing. Once the main bidders at the auction have dwindled away and they're just letting stuff go. This is marking it to market. The thing about this is this also applies to the financial system. And this was part of the reason why everything was over-leveraged in 2008. And now we're going to talk about deleveraging, now that we talked about mark-to-market. So deleveraging is basically when they make too much loans out at 0% interest rate and stuff like that. They inflate bubbles. And deleveraging is when these bubbles pop and there's no real buyers out there at exorbitantly high prices. It all gets basically marked to market. Now, because this caused the last financial crisis in 2008, the government has come in and said, hey, you know what? We're not going to allow this to happen again, so there's no more mark to market, marking it to market. We're going to, whatever. I'm going to tell you what, to be honest and fair, they can go ahead and they can say, no more, this won't happen again, so on, put whatever laws they want in place, doesn't matter. When the actual crisis comes and people start to liquidate financial assets, it's going to get marked to market. Honest to God, it will then. Doesn't matter laws or no laws. It doesn't work. It's just like when they put... country will come in and they'll say, okay, we're not going to allow price decreases anymore or price increases anymore. And they'll put in something to say, okay, you can't raise prices. Well, then what you'll see is long lineups and stuff. Price controls. When they put price controls, that doesn't work either. Just like pegging currencies together, like the real right now is pegged to the US dollar. In the end, it doesn't work. So when they say no more mark to market, that's well and fine for them to say that, but when the reality hits of the crisis, it's going to get marked to market. Same as it did back in 2008. Now here's the thing. The asset bubbles are all created from credit, and credit is actually debt. So what they've done is they've expanded the debt exponentially. Huge. And there's going to be a deleveraging. What a deleveraging basically means is that everybody wants to sell. This is basically putting it in my own terms. Everyone wants to sell. And it's what's called a buyer's market. The buyers have their choice then at that point. It's kind of like what's happening in China right now. They went through, in China, it's a seller's market for something that you wouldn't believe. I'll tell you a little story. Back a few years ago, the Chinese put in a policy, what was called the one-child policy. They said every family in China can only have one child. And it all sounded well and good. You know, whenever the government messes in anything, it always ends up turning out bad. But they thought it all sounded great, you know, so they put this policy and they instituted it. But the problem is every man, most men in China, I don't say every man, but a lot of the men in China, they want a son. They want an heir. And so they were bound and determined they were going to have an heir. So most of the baby girls, it didn't work very well. Let's just put it this way. The policy did not work very well. And now we have an oversurplus in China of young males with no bride. So what's happening is they're going back to the old thing of putting a dowry on the young ladies in China. There's a dowry. And they're having problems with these sort of things. So right now it's a market that the seller can set his price on his and this is what's happening. Maybe that wasn't really a good illustration, but that's what's really going on. And in the world, this is the way it's been during the credit expansion in all of the real estate markets. It's been a seller's market, and the buyers have had to sometimes wait in line to buy a house or put their name on a waiting list or whatever and pay more than the house is worth. Okay? When the system deleverages, it just moves in exactly the opposite direction. So everything reverses direction. When the system deleverages, it's basically all of these credit bubbles that have been expanded by cheap money deflate. And they're marked to market. And so that's what we're facing right now. Canada's got a huge real estate bubble. The United States has got a real estate bubble. It's not quite as big as it was in 2008, but it's pretty darn big. And it's isolated mostly to certain cities and stuff within the United States where the real estate market's popped again, blowing up, bubbles blowing up again. Australia's got a real estate bubble. The United Kingdom's got a tremendous real estate bubble. China's the biggest one of them all, though. Now, Canada probably could take the lead for the most inflated prices, but it's not the biggest. The biggest is in China. The China real estate market is an enormous bubble that's ready to pop. So we've got all of this inflated asset prices, inflated bubbles in the car industry is absolutely huge. The bubble that's in the automotive industry. And so when this deleveraging comes, you can bet your bottom dollar they're going to mark to market. Now, so this morning I mentioned capital flows. What actually starts to happen is as all these bubbles, like the Chinese bubble starts to pop, the United Kingdom bubble starts to pop, Italy starts to get into trouble, Deutsche Bank starts to get into trouble, the U.S. stock market starts to roll over, and the whole financial crisis all starts to congeal and come together, and everybody starts to get really frightened. Capital starts to move really fast at that point. People start to liquidate, and then they want to move their capital. They want to move it someplace. They want to move it to the safest place. Well, there's only the safest place that they're going to think to move it to is in the U.S. dollar. What it's going to do is it's going to raise, when the crisis actually hits, it's going to raise the U.S. dollar index higher. Bond yields are going to go higher too. The price of money, which is basically set on the U.S. 3-year Treasury, or I should say the 10-year Treasury, U.S. 10-year Treasury, excuse me, that is going to start to move upwards very rapidly. And that's the basis which all debt is weighed at. The 30-year is going to go up too, so is the 5-year. They're all going to go up. They're going to go up so fast that we're not going to get an inverted yield curve because the lower end of the yield curve is not even going to catch up with the higher end. First, see, to get an inverted yield curve, what we have to have happen is the lower end to pass the high end. But the high end's going to be moving so fast up that the lower end's not going to be able to catch it. And this is my opinion only. Some economists out there think that we're going to get an inverted yield curve and then we're going to get a recession. I think we're going to get a recession and don't need an inverted yield curve. We just need the bond yields to continue to climb, the price of money to continue to climb. As this price of money continues to climb, you're going to see these asset bubbles start to pop. Now, this recession that's going to come when the system deleverages and everything is marked to market. At first, they're all going to shift in to the dollar because it's the best choice. In the way they see it as being the only choice. Now, I see a new choice out there. And some of them are going to find that new choice, which is cryptocurrencies. Some of them, but not many. Most of them are going to flock into the dollar during this period in time. But this is going to be a very short-lived period of time, because this is going to be, when you deflate all of these asset bubbles all at once, caused by the Fed, by the way, and what their policy is right now. When you deleverage the system, it's going to be so severe and it's going to be so fast that it's going to, I believe it's very possible it could actually freeze the financial system for a very short period of time, causing a massive crisis that's going to require to be fixed. Believe me, there's not a chance in hell of this crisis not being fixed by the central banks. They're not going to sit on their hands and let a good crisis go to waste. They're going to fix it. This gives them a good excuse to bail out all their banker buddies and create money. And I mean, when they're in the money creation business and you give them the go-ahead, hey, we got a crisis. Oh, great, we got a crisis. How much money can we make? They're going to make as much money as is possible for them to make in such a short period of time, using the crisis as a reason to create all this new money. And simply for them, it's very easy. They just enter the digits into the computer and push enter. Bingo, the money is created. Doesn't matter. They can put as many zeros behind it as they want. Just going to add more to the debt. But what's that going to do to the dollar at that point? So what you're going to have is all these people flocking in to the dollar, marking everything at mark to market, asset bubbles popping, and the price on everything falling. The dollar being worth more and more. The U.S. dollar index going up, skyrocketing during the crisis. Everybody hoarding dollars. Seriously, it's almost funny, because that's not the place they should run to at that particular period in time. That's the most important period in time that they should be running out of the dollar, is when we see this happening. But that's not the way the herd mentality is going to work. The way the herd mentality is going to work is to hoard dollars, because dollars going up. And as they hoard dollars, it's going to make them hoard dollars more, and the whole thing is a self-perpetuating cycle. And it's going to be, they're going to be blind. These people are going to be blindsided, because it's at that moment that the Fed's going to come in and show them the power that the Fed has to create money. So they've been hoarding all these dollars. They got their little dollars like a bunch of little piggies with their little dollars, and they've got to put them all away for themselves. And they've sold everything at rock bottom prices to get these dollars. Flooded the market, and everybody's selling at mark to market. They're just trying to get rid of everything. So how much is your stuff, whatever you got, worth at that point in time when everybody's liquidating? Okay? And they're all hoarding these dollars, and then all of a sudden, the real kicker's going to come in, because the central banks of the earth are going to work in a coordinated effort to create massive amounts of dollars. What these people are missing, what's not cluing into their head, is that the central banks can create as many units of dollars as there are leaves on the trees. So why are they going to hoard it? But regardless, they are going to hoard it. The stupidity in it all. So when that reversal happens, when the central banks work in a coordinated effort to stop the crisis, and they will be successful, because they will print as much money as they have to print until they end the crisis. Bernanke said it. and he said it best, and that's why he got called Helicopter Ben. He said that if we're faced with a deflationary crisis, he said if we have to, we will print money and dump it from helicopters. And believe me, that will end the crisis. The crisis will end when the money rains down from heaven. But what does that do to the money? It makes it totally worthless. So here they all are. They've all ran into their dollars, and they all got their dollars, and then the Fed does a switcheroonie on them, and all of a sudden their dollars are becoming worthless. Well, now all of these goods that they've suddenly sold for bargain rock bottom prices, and everything's gone down to nothing price-wise, all of a sudden it all reverses. The whole thing reverses, including the fate of cryptocurrency. Because cryptocurrency is probably going to be, very likely could be one of the items that suffer some. Not as bad as some items. Some items are really going to lose value. But then all of a sudden, everything's going to reverse and go in the opposite direction. So first we're going to go down this way, and then we're going to come back up the other way. It's going to be the weirdest crisis. That's why Mike Maloney, I got to hand it to him, he had this thing pegged years ago. He called it the roller coaster. Because you go down, and then you go back up again. You go zoom down, then you go zoom back up again. Just like a roller coaster. And that's what it's going to be. It's going to be a roller coaster crisis. First deflationary. And then on the other side of it, inflationary. It's going to start out as inflationary. And then the inflation is going to pick up bigger and bigger and bigger and bigger and bigger until it turns into a hyperinflation. But this is not going to be like any hyperinflation anybody's ever experienced before. And in the beginning stages of the hyperinflation, early on when it's only inflation, but really good inflation, inflation like you've never seen before, really powerful inflation at the start, it's going to stimulate an economic recovery, a real economic recovery. Because what's going to happen is the system's going to be flooded with liquidity. And we've been going dry for a long time now. And when that liquidity floods into the system, it's almost like it's almost like a gasoline engine, you know. You ever seen a gasoline engine? A guy's feeding it with a cup of gasoline on the carburetor or whatever. Say it's an old engine, you know, one of these old engines that have carburetors. And he's pouring a little bit of gas down the carburetor, and he doesn't quite pour enough, and the thing's idling pretty good. And all of a sudden, she starts to stall. She's heading down the stall, right? And didn't quite pour enough. And then he starts pouring it heavier into the gasoline engine with the car, and all of a sudden she roars up. Well, the Fed is controlling that trickle feed. They're controlling that feed of gasoline into the engine, which is the money. They're controlling the money. Right now, what they're doing is they're starving it. They're withdrawing $50 billion a month liquidity out of the system. The system is going to stall. I mean, it's a no-brainer. People should see this coming. The system's going to stall. When it goes to stall, then they pour big time to try to get it going again. And it roars up. Roar! When it roars up like that, that's going to be our economic recovery. A real economic recovery. We haven't had one for years. And new job creation, money flowing, people. But what you're going to notice is during this economic recovery that's coming, when it gets going, you're going to see inflation like you've never seen before. So you're going to have one final chance to get in on some of these items like cryptocurrency, and I believe, this is my personal opinion, do not use this for financial advice, but I believe you'll have, during that economic recovery, you'll have one final chance. The items that you're going to buy might be higher than they are now, but not like they're going to go during the hyperinflation. Because the hyperinflation ultimately in the end is going to yield the destruction of the dollar and all of the other fiat currencies, and it's going to cause a transition over to cryptocurrencies and gold and silver. Gold and silver is going to be benefactors of this too. Gold and silver is going to take off like a skyrocket. And what you're going to see happen is you're going to see the gold price going so high in the end, and the silver price is going to even do better. And the reason why is because the gold to silver ratio is going to go back to a more normal area, more normal zone. So you're going to benefit even double if you've got silver off of this. Going to do awfully well. Cryptocurrencies are going to do awfully well. What's not going to do good is things that are denominated in the U.S. dollar. And that's what these people are going to hoard during the first stage of the crisis, which is the deflation. So, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye, guys.